Hello, everybody. Happy 2026, and welcome back to the Olympus Wealth Strategies podcast, where we help you take your finances to great heights. Very thankful to have a special guest on with us. He is the Senior Portfolio Manager for Tortoise Capital, Rob Thummel, and he really brings a wealth of knowledge. We're going to dive into energy, right? I'm sure over the holidays, we've noticed our energy bill, to say the least. And so Rob's going to talk about energy and the multiple facets of energy and how that all relates back to us as not only a consumer, but an investor. And so, Rob, thank you so much for joining us today.
Well, thanks for having me, John.
Really appreciate it. So, I always like to kind of let the audience know who the person is behind all the knowledge. So can you kind of introduce yourself and let us know who you are?
Well, wealth of knowledge just means I'm old, John. So I've been investing in the energy sector for over 3 decades. My name is Rob Thummel. I work at Tortoise Capital Advisors. When you think about Tortoise, well, what we try to be is your infrastructure experts, your energy experts. And so that's what I've been doing here for over 20 years. But like I said, investing in the energy sector for almost 30 years. And so seen a lot of market cycles, a lot of oil market cycles, a lot of just broad market cycles. So it's a great place to be. And I've stayed with the sector for a long time. We can talk a little bit more why. But anyway, it's been a great place to be.
Yeah. Well, you mentioned as far as kind of a couple of different things there. So obviously you've been managing capital through multiple market cycles and over the decades. Maybe from when you started to today, is there a common theme as far as what investors typically misunderstand about energy as it relates to the market today?
No, that's a great question. So obviously, one of the great things, and one of the reasons why I have stuck it out in energy for 30 years, is energy is just so essential for our daily lives, and it's becoming even more clear, I think, now with this AI revolution, and we'll probably talk a little bit more about that. But from the beginning, energy and economies basically went hand in hand. So for the domestic economy, for the global economy to grow, you needed simply more energy. And so that's really what people have underappreciated, I think, by the sector. Most people have associated energy with just oil. But the energy sector and investing in the energy sector is so much more than just investing in oil. And so I've stuck with the energy sector because there's been these long-term secular trends, and we've got another one now that's just emerged that's probably as exciting, or probably the most exciting in my 30 years of looking at the energy sector, and that's the AI industrial revolution. And so anyway, that's what I'm excited about going forward. But energy in general is just so essential. It's a foundational building block for everything we do. If you think about it, look around where you live or what you've done today. Basically, you couldn't have done any of it without energy.
That's right. And anything that we touch and feel and what vehicle we drive, it's all based on energy. And it's like you said, it's certainly a lot more than just the oil wells and watching Landman. So so let's maybe kind of dive into kind of energy transition here. So some questions that have come in. There's a popular narrative that we're rapidly moving away from traditional energy, the picks and shovels. So from your seat, what does the data actually say about global energy demand as we look forward over the next decade?
Yeah, so that's a good question, and obviously that's the narrative that's been out there, and people think about. What I think people as investors need to understand is global energy demand effectively goes up every single year. If you go back and look at history, it's risen, 30 out of the last 35 years or 30 out of the last 33 years. I mean, there's only been 2 years which actually global energy demand has declined. One was the global, the Great Financial Crisis, and then obviously the other one was during COVID. But besides that, you look back in history, energy demand goes up every year because it's absolutely critical for global GDP growth as well as domestic GDP growth. And so I think that's kind of what people are missing out on and not understanding. The U.S. though, in the U.S. it's even more I guess specific. What a lot of people don't understand is the U.S. has become the largest producer of energy in the world and the largest energy exporter in the world. And that's good in a lot of ways. First of all, there are tremendous investment opportunities as a result of that. But one of the things that the U.S. has been able to do is because of this massive amount of energy resource in the U.S., been able to be a producer of low-cost energy. And that's going to play a really critical role going forward, especially as AI really develops and the U.S. looks to be really the global leader in this and tries to win this AI race?
Yeah, so obviously at Tortoise, you all have a lot of areas of focus and expertise. And you mentioned it, so let's kind of dive into that AI and data center and power demand explosion. What's going on throughout the country, and even locally here in Arkansas, there's some data centers being initially constructed. So with AI everywhere right now, maybe a lot of people are kind of seeing how AI is, ChatGPT or Grok or some other sources. What does the rise in data centers actually mean as it relates to the power demand for those sources?
Yeah, no, and you're right. AI is everywhere. It's becoming our lives, and you mentioned it. We're all using all of these various AI applications, and there's probably going to be some new cool ones all the time. As energy experts, that's kind of where we really got focused on the opportunities in AI and AI infrastructure in particular. Because of what you just mentioned, John, we continue to follow the electricity demand and see announcements and talk to companies about the growth in electricity demand. And look, like I said, I've been studying the energy sector for 30 years. And if you go and look back over the last 20 years, electricity demand in the U.S. has pretty much been flat, right? I mean, obviously we've had economic growth, and we've had population growth, but we've also had some energy efficiencies as well. And so when you net all of that out, you end up with flat electricity demand growth. However, that's changing, and that's where we have seen this opportunity, and AI changed all of this. And so as AI has continued to develop and the projections on future AI applications, we've seen a step change in electricity demand growth, going from basically 0 to 2 to 3% a year for decades going forward. And you say, well, 2 to 3%, that's not much. Well, when you compound that, that is a tremendous amount of new electricity, of terawatt hours, which is a measure of electricity that needs to be generated over the next several decades. And that is, we think, a significant opportunity here at Tortoise that we're capturing in multiple ways for investors.
And you mentioned as far as those terawatt hours, so maybe can you kind of educate me and our audience a little bit more as far as how energy intensive is AI compared to maybe prior tech revolutions?
Yeah. Well, a ChatGPT, you do a standard ChatGPT query, that uses like 10 times the amount of electricity that a Google search does, right? And so a lot of people in the tech world are talking today about, is ChatGPT going to win? Is Grok going to win? Well, that's fine. Somebody's going to win, and there'll probably still be multiple search engines, AI search engines. But what we do know is every single one of them is going to require more electricity. And then think about what's also happening. These prompts that we're all typing in, because they're so good, we're typing in longer prompts, right? So that takes even more electricity. Now we're starting to create videos, right? Sora and things like this that are becoming AI applications. Well, the electricity demand gets goes off the charts when you think about creating a video versus just a ChatGPT search. I mean, it becomes 10,000 times more electricity than a Google search. So the numbers just keep going up and up and up. And I think when you listen to a lot of these tech execs from NVIDIA and other developers of AI applications, I mean, at its essence, AI and these searches are effectively two things. They're about data and they're about electricity. And so the demand for electricity and the need for electricity is going higher. And obviously the technology's there, it's available, can continue to be developed. The tech executives, I think, just want to make sure that they don't get too far ahead of themselves on the technology and make sure that the electricity is available to power these AI applications. And that's really where the energy sector's playing a really, really important role.
So, Rob, I know you mentioned the electrical component. Are there any other kinds of energy, just general infrastructure that's going to be needed to support this growth, whether that's transmission, pipeline, electrical, anything else as it relates to the general AI boom?
Yeah, probably a couple things, John. So the way we look at it, Tortoise, number one, on the energy side, if AI at its foundation is more data and more energy, Well, how are we going to generate all of this electricity, and what's going to be the fuel supply source? And so, and we're going to grow. Like I said, we're going to more than double our 4,000 terawatt hours a year that we generate today, and that's going to grow well into the future by 2030. And you say, well, what does that mean? Well, that's like adding multiple Japans in terms of the country of Japan to the U.S. electricity grid. So it's a massive amount of electricity. Now, where are we going to generate all that electricity? It comes back to the fuel supply source. It comes back to the cost. So from our perspective at Tortoise, we think that natural gas is going to lead the way. Nuclear is also going to play an important role because both of those are going to be really critical to generating future electricity from a supply perspective. You look today, natural gas is the largest supply source to generate electricity in the U.S. We don't think that that's going to change. Natural gas will continue to be the leading supply source and will gain market share actually between now and 2030. But nuclear will also gain some market share as well. Nuclear will benefit from just a rising demand, but also, coal is probably on its way out. Natural gas, nuclear are the new areas where we're going to be able to generate more electricity from, at least from a supply source perspective. So we especially like the opportunities in natural gas and nuclear to a certain extent, and natural gas in particular because it's low cost. We have a massive amount of natural gas here in the U.S., and that allows the U.S. to produce low cost electricity for a long period of time. And the cost of electricity actually is going to be one of the big benefits for the U.S. to win this global AI race.
Well, kind of one more question before we transition to one of the topics you just mentioned. As it stands today, are the utilities and grids prepared for that level of demand shock year over year?
Well, they're preparing, and that's a good question. So you've seen all these estimates and these capacity auctions and all this kind of stuff that I can get into minutia on if you want. But big picture, the regional transmission authorities, the utilities in these various regions, like Data Center Alley in Northern Virginia, or even in Arkansas and in Texas and in Pennsylvania, they're preparing to build the power that's necessary to handle this tremendous growth, and that's where you start to see the growth when the electricity providers in places like Northern Virginia provide estimates. Dominions is one of the biggest ones. Their growth just grows every year. I mean, their forecasts for growth just grow every year, and so they have to prepare for this, and so we're in the process of building electricity, and setting up, building the pipelines, building the electricity, building the production, building the nuclear facilities. You've seen that. We can talk about that in a second. But you've even seen new nuclear facilities being built. Nuclear technology like small modular nuclear reactors are coming to really to provide electricity as well. So there's just so many different ways that the energy sector is going to participate in this demand growth for electricity going forward. And there's so many investment opportunities as a result.
Well, let's jump into nuclear. And so I don't think it was that long ago, Rob, and you could probably educate us on this, that the topic of nuclear here in the United States seemed to be politically radioactive, right? And now it's back in the conversation. So what changed?
Well, just this, how are we going to meet this power demand source? And, it's interesting. A lot of people have written about nuclear, and I was having a discussion with a Wall Street Journal reporter one time who wrote a great story about nuclear and nuclear energy coming back. And obviously those great writers of Wall Street Journal get feedback all the time. And he told me, he's like, it's interesting. We got the feedback I got on this was I would much rather, as a reader of the Wall Street Journal, and have a nuclear facility in my backyard than I would a windmill or a solar farm. Which the point of that, John, is that just shows you, to your point, the sentiment surrounding nuclear of the American public and maybe the world has entirely changed. And so now, the American consumer and probably the global consumer is more worried about the cost to us, right, as a consumer of electricity. And what nuclear can do is it can keep that cost down for an extended period of time. And so that's why nuclear, I think, has come back. It's become it developed as a safe alternative, and we still need to have regulations to make sure that continues to be the case. But it also can be a low-cost alternative as well going forward, and we're going to need it going forward as well.
Well, and you mentioned it being really in the mix for the level of energy it can bring at a cost efficiency that it can deliver upon. But at least I'm sure you see all the same general headline news when we go home at night of these images of nuclear power plants that have not been serviced for decades. And they talk about whether it be the capital intensity or the time horizon to get those back up and running. From your end and Tortoise's end, do you see kind of a long runway to get that going, or is it kind of all hands on deck and there's being a lot of money poured into it at a rapid pace to get those up and running quickly?
Yeah, so no, it's a good question. So I think a couple of ways to answer that. So number one, you're right. There have been some nuclear facilities taken offline all over the country that are coming back online, whether it's in Florida or Michigan or even 3 Mile Island in Pennsylvania. Now that to me is more of an indication of just the absolute demand for electricity going forward. You've also heard about, and a lot of your investors and a lot of your clients have probably heard about small modular nuclear reactors that Oklo and Sam Altman, who's done some amazing things, and these are shorter. Well, I'm not going to call them shorter term solutions. They are technological solutions that could be very effective going forward. But I do have to remind everybody, there really are no small modular nuclear reactors operating in the U.S. at the present time. And so we at Tortoise study all energy technologies, including small modular nuclear reactors, every day, just to figure out, okay, well, where's the new energy supply source going to come from? And small modular nuclear reactors may be a large component going forward, but it's going to take some time. This is going to be 2030 and beyond, because number one, the U.S. and part of that's in place already. The U.S. needs to enrich more uranium for these small modular nuclear reactors. So we've got to get we got to get the uranium value chain in place. We've got to get more uranium. We've got to get more uranium enrichment capacity in the U.S. And all of that is starting to happen right now, but all of that needs to be in place. We need to make sure we have the safety regulations in place, because when you enrich uranium, you just don't want everybody to have access to that. So there's all those type of things that need to be put in place, and that just takes time. Once again, that's what we do at Tortoise. We study the whole energy sector, all new forms of energy technology, and frankly, as we look at small modular nuclear reactors, there's still development that needs to happen. But it is an exciting technology to look at going forward, and we'll follow it very closely.
Well, let's maybe shift a little bit more towards infrastructure in general, and where people are thinking and seeing on the news pipelines, electrification, midstream. Can you help us kind of understand a little bit as far as energy infrastructure? It doesn't really get the headlines unless there's some big, it seems like, political thing that either passes or gets struck down. So why does it seem like maybe it's always the pendulum is swinging and it can create a bottleneck when that stuff happens?
Yeah, so no, that's a very good observation, John. So at Tortoise, we've been investing in energy infrastructure for, like I said, for 20 plus years. We always think it's been underappreciated at Tortoise, and here's why. If you think about it, goes back to the original or the start of this discussion. Nothing happens without energy. Reindustrialization in the U.S. can't happen without energy. Just our daily lives, driving our cars, heating our homes, none of that works without energy infrastructure. And so AI. There is no AI without energy infrastructure. There is no AI without infrastructure in general. So the way we look at infrastructure at Tortoise is a couple ways. Foundationally, energy infrastructure is really important. Hey, well, look, we're blessed in the U.S. to operate the largest energy infrastructure network in the world. And that's really important because the U.S. is the largest producer of oil and natural gas and energy in the world. We are the largest exporter of energy in the world. And we're able to do that all because of this vast amount of energy infrastructure we have. And it's pipelines. You're right. You never see, you highlight it. You never hear about it, except maybe once or twice, maybe a decade, maybe every 5 years. And that's because there's some problem with infrastructure. Maybe there's a pipeline leak or something along those lines. And there are regulations in place that try to prevent major pipeline leaks, and that they're effective because you don't hear about infrastructure very often. But what that then really correlates into for investors are these businesses. They're boring businesses, but they're really essential businesses. And they generate a lot of cash flow. And they generate a lot of free cash flow. And they return that to shareholders and your clients in the forms of high dividends, growing their dividends, and stock buybacks. And so that's where we see some opportunities. We also see the infrastructure sector generally, broadly, expanding to include not just pipelines, but in the form of modern infrastructure, we expand that to include things like AI infrastructure, right? So AI infrastructure is another area we think that investors are underinvested in. And your clients probably, and you've probably done a great job of investing them in mega cap tech. That's been phenomenal. But AI infrastructure is expanding as well, and it's part of now the modern infrastructure. So what I'm talking about is investment in things like data storage. I'm talking about things like network switches, obviously electricity, and liquid cooling devices. That's expanding. We see opportunities there as well.
Well, I guess as it relates to all that infrastructure, whether it be kind of the traditional, even the more modern, how difficult is it to permit and get that those picks and shovels in the ground in today's regulatory environment? Is it relatively difficult, or is everything kind of pressing on full steam ahead, knowing that we're going to be adding the level of a Japan every year or every couple of years to our electrification demand?
Yeah, well, you've probably seen in Arkansas the development of data centers, right? So data centers are popping up all over the place, and they're massive, right? You're seeing data centers, in northern Louisiana to support, some of the meta really developments that they're building these data centers on land that's the size of Central Park, right? And so they're building these massive data centers everywhere, probably in Arkansas as well, and other areas around the U.S. Yeah, is it difficult? Sure. But I think it's gotten a little bit easier. Now, because, you're talking about state and local governments, and there are incentives obviously provided to some of these data center operators. Now, pipeline infrastructure, it's still difficult, right? Because you've got to deal with the federal government, the state government, the local jurisdictions. And so the way we've looked at it at Tortoise is, look, we do operate the largest pipeline network in the world, and it is harder to build new energy infrastructure. And so, if we're owners of energy infrastructure assets, there's a bit of a scarcity value, I guess, in existing infrastructure, because especially pipelines, because it's harder to build pipelines. So the value of existing pipelines should be worth even more, in our opinion, than what they're currently being valued at. Because these oil and gas pipeline assets that are in place, they're long duration assets. The longevity of them is going to continue to extend. Their lifespan is going to continue to extend, especially with this new demand, as you highlight, from electricity demand growing for decades going forward because of the AI opportunity.
Well, from what you just mentioned right there, Rob, so just kind of a general question that popped up is, do you see infrastructure as more of a defensive investment allocation than maybe more upstream energy?
Yeah, but it's also growth, right? Because of AI. So what do you get with infrastructure? You're right. You get stable assets, consistent cash flow, kind of fee-based cash flows, which the question is accurate. Those are aligned typically with defensive industries. But what you also get now with infrastructure, because of AI, is a growth element, right? And look, they're not going to be mega cap techs, but they're still going to grow. These infrastructure assets are, and the volumes and the cash flows are going to continue to grow. The dividends are going to grow, and so yeah, there is definitely a defensive nature of it. But I don't want your clients to miss out on the growth opportunity as well.
Right. Well, let's maybe talk about something that really gets, at least from my seat, overlooked. Maybe not so much from yours. And that's water as it relates to energy. And so obviously water and energy are deeply linked, but how are they connected as it relates to Tortoise and your space?
Yeah, no, that's a good question. So we have an active ETF that focuses on water, but or passive ETF, I'm sorry, that focuses on water. But well, if you think about water is really critical in developing oil and gas and drilling for oil and gas. There was a great story in the Wall Street Journal just a few weeks ago by Benoit Morin about what's happening in West Texas and the need for water, and then making sure that water is handled appropriately. And I don't mean to get into the technical details, but the point of the story is if you don't handle the water appropriately, you end up causing earthquakes. And we've all heard about that, and that's been a criticism of oil and gas. But one of the great things is a lot of these pipeline companies, and we own a couple of them, like Western Midstream and others, have done a great job of developing water pipeline infrastructure. because you need this, because you need to recycle water. I mean, obviously, water is a scarce resource, and it's a really important resource going forward, domestically as well as globally. And so you need to make the best use of the existing resource that we already have. And so a lot of these pipeline operators are participating and helping with that. And so we invest. So on the passive ETF side, we focus on water, not only just on the pipeline side, but also on energy technologies as well that help boost the efficiency of water and capitalize on ensuring that, yes, water is scarce, but we also need to maximize the efficiency at which we use water. And so we own it both passively, but also in our active strategies, where we invest in some companies that actually are, like I said, like Western Midstream, that are actually building water pipeline networks to really benefit the oil and gas producers and improve the efficiencies around their use of water in the drilling for oil and gas. Oh, by the way, I forgot to mention too, AI. If you think about AI, inside these data centers get really hot, as you can imagine. And so you've got to cool these data centers. And what's interesting about water is you need a lot of these liquid cooling devices. And without getting into too much technical detail, liquid cooling devices are placed inside these data centers on the racks that cool these chips all day. And so what does that mean? Well, bigger data centers, more data storage, more racks, more cooling, more water. And so, water plays a really, really important role in the current economy, but also in the new AI economy that's developing as well.
Well, maybe let's kind of put all this together, Rob. So if, everybody's sitting back listening as an investor, how should they be thinking about energy in their portfolios today?
Yeah, no, that's a good question. So I obviously Tortoise, we think investors are, really underinvested in energy. Energy is a small piece of the S&P 500. And a lot of that is, Exxon and Chevron. But energy's so much more important in our daily lives, and so much important as part of the global economy, and going to be so important for AI to develop. And so we think that, energy should be a much bigger piece of investor portfolios. And so, what's the best way to play? Well, there's multiple ways to play that. We try to capitalize it in a couple ways. In particular, electrification infrastructure that, is what I'm talking about. We have an active ETF, TPZ, that factors on, that's the Tortoise Electrification Infrastructure Active ETF. And it focuses on electricity, and this electricity thing, the electricity growth we're talking about, and the opportunities around that. And we think that that's really a great way to invest in energy, but also get exposure to this AI trend as well that's happening as well. We've just got a broader energy fund too that capitalizes a lot on the natural gas opportunities across energy and the natural gas demand growth. And then of course we've got a nuclear active ETF that we just launched that we think has tremendous potential given what we've been talking about, the growth in electricity and the role that nuclear is going to play over the long term in meeting that long-term electricity growth demand.
One of the most requested questions that came in from our clients as it relates to this podcast episode is, given the severe increase in price on precious metals, and as it relates to all of this demand for infrastructure and building and all the materials and components that go into it, are these, Rob, from your seat, is all what's happening between the picks and shovels for AI and some of the other energy, is that swallowing up a lot of the supply for all these precious metals that are needed? It would driving the prices up, or is there more plays going on than just that?
Yeah, obviously, I think your clients have raised a good question. I mean, all of this goes into the cost to us as consumers, right? And that's why we're big fans of natural gas, because we think that natural gas in general can help keep the costs down. Precious metals have gone up because, we're going to need a lot of copper and lithium and things like that. Lithium is used for electric cars, and so obviously copper's used in a lot of electronic applications, including a lot of what's going on in AI and the server racks and things like that. So the increase for demand for those precious metals has been a function of this AI development. And you've seen the AI capital spend. But what we try to look at is, well, ultimately, what's going to be the lowest cost energy supply source? Because energy is so foundational, that's why we really focus on natural gas and to a certain extent nuclear as well, because those two commodities are going to be the reason why the U.S. wins this AI arms race, because they'll be able to keep the costs low. And so that's why we look at those two. Uranium is in the mix, I think, as well from a nuclear perspective, and we keep our eye on that. But we see tremendous opportunities, especially in natural gas, especially across the natural gas value chain, whether it's the producers, the natural gas pipelines, but ultimately the consumption of natural gas is going to go up and rise significantly and grow by double digits. Ultimately because of the low-cost nature of it, and that's because of the amount of supply we have here in the U.S.
Well, Rob, maybe as kind of we close out the podcast here, from the evolution of energy that you've seen throughout your career, and especially the last couple of decades with Tortoise, if we're sitting here in 2035, where do you see energy being at?
Yeah, that's a good question. I see a lot more energy, right? I mean, the future of energy is significant. Now, what I do see is electricity becoming the new oil, right? And that's what at Tortoise we're excited about. Oil, and back to our original question, John. I think it's a good one. Oil used to dominate, and oil and energy were synonymous, but now we think electricity becomes the new oil. And oil will still drive economies and is still relevant, but electricity is now going to drive this AI-driven economy. And so that's really where investors need to pivot and take a look at from an investment perspective and say, hey, do I have enough exposure to electricity becoming the new oil? Because there are a lot of opportunities there. And like I said, and we try to provide solutions for investors to via active ETFs to invest in this electricity theme and electricity becoming new oil. And that's where we think really investors are maybe underinvested, as well as a little bit in AI infrastructure as well. A lot of it overexposure at mega cap techs, but underexposure to really AI infrastructure and electricity in general.
Well, Rob, we really appreciate all the wisdom that you shared with us today, obviously giving us a really good understanding of what's going on in just the energy markets, but also being able to shed some light on all these different areas that are really important. And there's a lot going on behind the scenes that maybe most of us don't see on the headlines. So really appreciate you making time and coming on to the podcast. Well,
thanks for having me, John. And it's great to meet you and all your clients as well. Happy to do it anytime. Thank you.
Hey, thank you so much. And everybody, we're so excited to have Rob shed light on this. And we're looking forward to seeing you all on the next podcast. Thank you.
All opinions expressed on the podcast by the host and guests are solely their own opinions and do not reflect the opinion of Olympus Wealth Strategies or Uptick Partners, a registered investment advisor. This podcast is for educational purposes only and is not legal advice and should not be relied upon as a basis for any decisions. The investments discussed on this podcast may not be suitable for all investors and involve risks that should be carefully considered. Listeners are encouraged to consult with a qualified financial advisor before making any investment decisions. Certain investments may require specific investor qualifications, which not all individuals may meet. Any funds or companies discussed are not a recommendation or endorsement. Guests in the podcast might be actual clients, but are not compensated to be on the show, and their experiences are not representative of all relationships, which might differ substantially.